Hello, I'm Hutch. I am your one-stop financial supermarket with home delivery. I help families earn more income, get property protected, debt-free, and financially independent. Today is video 5 of our series, How Money Works. All right, and we're going to talk about bypassing the middleman, being an owner, not a loaner, and of course, what you've been waiting on, how we are comfortable doing these amount of a return on the investments. All right, so we want to get started. We're talking about being an owner and not a loaner. What does that mean? Loaner, okay? Loaner means we're taking our money and we want to be safe. We want to have a guarantee, right? So most of us are taking our money and putting it in a bank or a credit union. It's safe, it's guaranteed, right? So what are they guaranteeing you? Let's look at that, because you're getting, I did a blog on that, new investment idea. Let's loan our money to the banks, because that's actually what we're doing. Is when we put our money, we got here your money, $10,000. I've got, that's a bank, in case you're wondering, and I'm calling that the middleman, but it's a bank or a credit union, all right? So we're taking our money, $10,000, and we're putting it in the bank. Now we're going to give the banks the benefit of the doubt, and we're going to say they're going to pay us 1%. Now this is guaranteed, you know, it's insured, all that good stuff. So if you earn 1% on $10,000, at the end of the year, you're going to have $100, right? Now, let's look what's all happening. Uncle Sam's taking 25%, okay? 25%. So your net investment at the end of the year is going to be $10,075, right? Inflation grows at 3%, average, somewhere in there. So in your investment, your buying power is $9,782. All right, so what did the bank guarantee you? Guaranteed you a loss, didn't it? Because your $10,000 earning just $100, even if you didn't pay any taxes on it, you still lost buying power. All right, because it's not staying up with inflation, right? So you're guaranteed a loss in that bank. That makes sense? Hopefully it does. All right, now look, I am securities licensed, so I have to tell you this a little bit. Being securities licensed, I can do hypotheticals like I did on the other videos, say 9%, 3%, all that stuff. That's okay to do this. But when I start getting down to investments, I cannot project. Okay, I cannot. It's illegal for me to project what you could have in an investment. So what I have to do is I have to back up and I have to say, you know what? The difference is I can backdate it. I can say, if you'd have put this money in this investment, this is what it would be worth today, and that's actual numbers. And what I want to talk to you about is the S&P 500, all right? What is the S&P 500? The S&P 500 is the Standard & Poor's. Sometimes you hear it, or you see the little ticker thing on the news saying the NASDAQ did this and the S&P did this. Standard & Poor 500, that's the 500 of the largest publicly traded companies, all right, that make up this 500. Now, and I'm going to use their index for this situation. So in this situation, I'm going to say that we went December 31st, 1987. We kept that money in there till December 31st, 2017. 30 years, okay? Keeping that money in there 30 years. We actually, the only hypothetical part about this is you putting the money in there. But if you would have put the money in there, and somebody did, all right, through this time, in December 31st, 2017, that money would have grown, be worth the $10,000 would be worth $210, make sure I got my numbers right, $974. All right, you know what that is? That is a 10.69% average rate of return. Am I comfortable with doing hypotheticals at 9% all day long? Because the Standard & Poor, that's kind of the what everybody looks at is the industry average. They compare their investments to this, okay? So 10.69%. All right, now that's in the stock market, right? And everybody's like, oh, the stock market, this and that. But if you wanted a little safer investment, you could have invested that same amount of money in bonds, right? Same time period. In bonds, you would have grown to $63,659. That's a 6.36% return on your money. Not as good as that, The risk is a little different, bonds a little different. Now, if you did a 30-day T-bill, same amount of time, your account would have grown to $24,773. That's a 3.07% return on your money, right? All right, these are awesome, right? 3.6. That's kind of like almost close to what we're talking about the banks getting, right? But now we have to be fair. We have to be fair, right? Because before I said the inflation ate up your buying power. So in that 30 years, the inflation rate was 2.56% average. So the $10,000 would have to grow to at least $21,376 to have, that's the buying power over 30 years. Your $10,000 would have to be worth at least $21,376 to make any money. If you made anything less than that, then you're just like the banks. You're losing money, right? And you just click out the video because you're not doing it. Okay, but the T-bills at 3.07% did this. You're a little bit over. The bonds did a lot better than that, and we're way over what inflation is. Now, you're working hard for your money, right? Is your money working hard for you? If you're not getting past inflation, oh, no wonder you're frustrated. You can never get ahead, right? So this is the reason. We need to get above inflation. Start making your money work harder for you. Is that working hard for you? I believe so. It can work harder. There's different funds doing different things. So when we say that, now everybody's worried about the stock market. Everybody freaks out over the stock market. Hope you got a picture of that freeze frame or whatever you want to call it. Picture of the frame there. All right. So what is the stock market? How does that work? All right. How does that work? Let's pick some stock. I know. Oh, I got you. You typed in there Netflix. I like Netflix. Hope I've did this right. If you bought one share of Netflix, you would need $351.14. And this is, I pulled these off yesterday, so if they're not current, this is just an average. Don't get all upset if I mess this up. But it's somewhere in this neighborhood, all right? Now, if you wanted to buy one share of Facebook stock, you would need $179.10. Apple, you would need $198.87, right? Another good one, Microsoft. This is one of the lesser ones. Microsoft, right? Is $120.97. Now, the one I like, and or 95. One that I like a lot, and I shop there, is Amazon. Most people recognize Amazon, right? Amazon. If you want one share of Amazon stock, what is that? What is that going to cost you? $1,843.06. Okay, now you got TD Ameritrade. You got all these people out there advertising. Oh, you can buy stock $5.95 a trade. You don't have to pay the broker. Blah blah blah. All this stuff. Now, throughout all my scenarios, we talked about a cup of coffee. We talked, and I'm not talking fast because I had a lot of coffee, but anyway, we talked about saving that cup of coffee, $5 a day, $25 a week, $100 a month, right? So if you were doing that and you went to TD Ameritrade and you said, oh my goodness, I got to give up a lot of coffee or a lot of time to buy one share of any one of these, I'd just go back to drinking my coffee. It'd be overwhelming, right? You don't want to do that. I mean, how long would you have to save to get one share of Amazon? Is that crazy? So what's a better way to do this? What is a safer investment for people like me and you that want to save $100 a month, $500, whatever your game plan is, whatever your goal is to reach your FIN number, right? Your financial independence number. What is that? So we got to figure out what we're spending a month, right? Now, can we do this in this? Yes, but it'd be tedious. Then you gotta follow the market. You gotta say, when is a good time to buy Apple? If this is the high, no, I need to buy at the low so I can sell at the high and make some money. You have to get on there and you have to do all this figuring and stuff like this. The safer way and better way is to invest with professional management. We talk about mutual funds. What is a mutual fund? Okay, what a mutual fund is, professional managers taking a pool of money, and the pool of money is from investors like me and you that are putting hundreds of dollars in a month, thousands of dollars, whatever you're putting in, into a pool of money, and then they take in their mutual fund and they have objectives of what they're doing, growth and income, long term, all this stuff that's in the prospectuses that you get when you do these investments. But in essence now, this is not picked from any one mutual fund. This is just 5 companies that I know everybody probably has heard of, okay? And I just wanted to show you the example of what it costs. But in a mutual fund, if they said they liked all these things and they did the research on it and they said these are good companies to build a good mutual fund on, and let's do these 5 plus another 150 different companies, they take your pool of money and they buy stock in these companies, okay? And then they manage the portfolio. So when they take this mutual fund here, they say, okay, for you to get in with your $100. Now, one thing I missed here is if you wanted to buy stock in Netflix or Facebook, you have to buy, I think you have to, well, I know you have to buy the whole share. They won't do a half a share or a quarter share. You have to buy at least one whole share. Sometimes you have to buy a block, okay? Sometimes they don't let you just buy one. It's not really worth their time to let you do one, okay? So the professional managers come in and they say, okay, we think this is good. We're going to do this, and then we've got X amount of people investing, so, and it's worth whatever, and they say to get in my fund it's going to cost $30 per share. They sell shares of the mutual fund. Okay, now you own part, they own the shares of this, the stock in this, not the companies. They own the stock in these companies. And they say, all right, so my mutual fund, Middleman mutual fund, whatever you want to call it, and this is just hypothetical, but this is how it works. So when you send in your $100, you start saving your coffee money, and you put it in, and you say, all right, I want to put my $100 in this fund here because it's average something that hits me attain my goal. All right. When you send in your $100 a month, if it's at $30, you're buying 3.33 shares of that fund. If it fluctuates, which you'll see in the next video, or not the next video, here in just a second, about the fluctuating market and rising market, which is better, which is worse, and not to worry about it. But anyway, this will fluctuate. As long as you keep that $100 going in there, it'll buy either more or less if this is going up or down, right? But you're going to buy 3.3 shares, and you have kind of a piece of all of those stock in there for $100 instead of trying to buy 1 or 2 of those stocks. And then you're also, the good thing about this is if you actually saved enough money to buy 1 share of Amazon, you're kind of, if something happened and it goes down, that's your one thing. If you're buying part of a mutual fund, not only you got these 5, you got another 100 different stocks in there in different industries that make up that mutual fund, okay? So if one goes down, now don't get me wrong, the market fluctuates. It's not guaranteed you're having money, but you can see how the risk is kind of lessened by the diversity of the fund. All right. So, and it doesn't get any more complicated than that, but each fund is different on what the objectives are and the returns and what they're trying to do for you. And that's what we kind of do when we do the FNA. We sit down with you and we see what in the world you're trying to achieve. And then we put you with the right couple of funds that get you to your goal, okay? That's the simple plans that we have for that. So this is kind of what a mutual fund is, a pool of money that professional managers invest the money for you. So they're looking at the market all day. They're the ones that know what's happening, the ups and downs or whatever, and know when to buy, when to sell, or when they're getting dividends or whatever, okay, on that. So that's what we want to do. You want a safer investment, getting the biggest return that we can get for you. All right. So, all right. Now we're doing a little bit of splicing for the sake of time, and we've talked about mutual funds. We've talked about the stock market, and what I want to go over real quick is dollar cost averaging, which kind of helps you understand the rising market, fluctuating market. People are scared of the stock market because it's up, it's down, you just don't know what's happening. and they're not real comfortable with it, okay? So I've got two investors behind me. One that's investing $100 a month in a rising market, and then the other one is investing $100 a month in a fluctuating market. It's going up and down. All right, so let's look at what happens with these two investors real quick, okay? We got investor A, rising market. This is $100 a month, and we're only going to do this for 6 months, okay? And the price per share is this line, and then the number of shares that they accumulate would be the green line here. And then investor B, same thing, and then his or their investor B is the number of shares on the bottom here. So let's look at the rising market. So this is the price per share. It's going up each month. It's a rising market, right? The first time you're buying, you put your $100 in, it's $10 a share. Then it's $12 the next month. $100 going in is $14, $16, $18, and then the 6th month it's at $20 a share. So each month you're putting in your $100. Now the first month you're buying 10 shares. The second month, because the price of the shares are going up, you're buying 8.33. It's higher, 7.14. 16 is 6.25. $18 a share. Your $100 a month is buying 5.56 shares. And of course, the last month, the 6th month, the $100, you're buying 5 shares. So through this 6-month period, you have a total of, in this mutual fund, is 42.28 shares of the fund. All right, makes sense so far? Fluctuating market, same thing. Investor is spending $100 a month. In the first month, just like the top one, it bought 10 shares. Second month, it starts to take a little bit of a dive. It's $7 a share. It bought 14. Third month, it's taking a bigger dive. It's going to $4 a share. So your $100 a month bought 25 shares. Now, everybody starts to freak out when they see the 4th month, and it takes a dive to $2 a share. But you are disciplined. You have watched the videos. You know what to do. You keep putting your $100 a month in there. It buys 50 shares. The 5th month, it starts to go back up. It's going to $6. It bought 16.67 shares. And then, of course, the 6th month, it goes back up to $10 a share where you started, and it buys 10 shares. But through this period of time, in the volatile market going up and down, we've bought 125.95 shares of that mutual fund. So what does that mean? What does that mean? All right, so for one, you want dollar cost averaging. Dollar cost averaging says that we've invested $600, okay, divided by the number of shares. Up top here, your dollar per share is $14.19. Your dollar cost averaging for the fluctuating market is $4.76. Okay? That's your average cost per share. Does that guarantee any money? No, it doesn't. It just makes sure that you know that fluctuating market is not a bad thing. Or a rising market, either one. Now just look at this real quick. At the end of this, there's a $400 difference in what this investment is become when you average this out, because this is $848 and this is $1,259. All right, so the fluctuating market, you bought more shares. So if this was to ever keep going up, you would have more shares. And again, if it dipped down, you're buying more shares. Then it's not a bad thing to fluctuating market. You work to your advantage. Again, the stock market is not guaranteed, so kind of flips people out. But anyway, if you want those kind of returns, then we need to step it up and get into the market. All right, now the 3 Ds of investing. Dollar cost averaging is one. Discipline. Like I said, this guy, even though the market was going down, kept his $100 a month. Remember, what did we say? What's the biggest thing you had to learn of these whole thing of the first video? Was to pay yourself first, just like a bill. Make sure you're paying yourself every month. $100, $300, whatever you're doing has to be put in. Every time you pay off a bill, instead of making another bill, put that money, pay off the rest of your bills, and start putting that more money into your account. And you get excited because you see that account growing, and it's growing in leaps and bounds sometimes. It'll go down and go up, but you'll see a good improvement in what you're doing. So, and then the last D, the third D, is diversification. You see how the mutual fund is built, where you don't have all your eggs in one basket and you're trying to buy a lot of shares of Amazon or one stock. in a mutual fund, the diversification lessens the risk. Now there's bigger risk and all this other stuff if you do different kinds of mutual funds, but that's neither here nor there. You're diversified amongst a bunch of different companies inside of a mutual fund. Okay, yes, you can lose money, I have to say that, but we look at track records, what they have done through the years. Okay, just kind of like the S&P that we looked at, where it's averaged 10.69%. It's done that from December. Now, is that a guarantee it's going to keep doing that? No, it's not a guarantee. Okay, but history usually, like I said, I'm not scared to show somebody a 9% on a hypothetical all day long, because there's a lot of funds out there, a lot of funds out there that are doing that well. It just depends on what your goal is, what you're trying to get. Okay. All right, now we've gone over a lot of things, and I know that achieving your financial security might seem a little overwhelming right now, but as you've seen in these videos, the path to your financial independence starts by understanding these basic common sense principles and implementing them in your life. Okay, remember, I stress the implementing, because you just can't watch the videos, you just can't read the books. You actually have to do something to make a change. All right, now in these basic common sense concepts will put your financial success within reach. All right, now hopefully you're not waiting on a financial miracle to happen to get this done. You'll take these proven strategies that have already helped a lot of families, all right, and put them in place. Now, the most important thing is that no matter where you're at in your journey, your situation, whatever it is, the key is to start today. High cost of waiting, remember? Okay, the key is to start today, and you'll be amazed if we contact me. We'll put a simple plan together, and it is a simple plan. It's not rocket science, or Hutch wouldn't be doing it, all right, if it were rocket science. So let's put a simple plan together, and you'll be amazed at how fast and the progress that you'll make in doing things the right way. All right, you can do this. I know you can. It's up to you, remember? All right, I'm Hutch. I am your one-stop financial supermarket with home delivery. I help families earn more income, get property protected, debt-free, and financially independent. Look forward to talking to you. Thank you.